The year is 2012. A conference room in a Midwestern city is filled with municipal workers, teachers, firefighters, sanitation crews, waiting for answers. At the front, a pension board official clears his throat. The numbers are final. The fund is now billions of dollars short. The room doesn't erupt. It goes quiet. Because everyone understands what that number means. Retirement is no longer a guarantee. Across the country, in glass towers in New York and Chicago, fund managers are reviewing a different set of numbers. Returns, allocations, projections. On paper, the system still looks intact. Diversified portfolios, sophisticated risk models. Strategies designed to deliver stable, long-term growth. But the gap between the promises made and the assets available is widening. And it has been widening for decades. How does a system designed for security accumulate a shortfall measured in trillions? Where did the money go? Was it ever really there? To understand what happened, you have to start with a simple promise made in the decades following World War II. Industrial output surges, wages rise, corporations grow, work for us for 40 years, and when you retire, we will take care of you. This is the defined benefit pension plan. An employee contributes. The employer contributes more. That money is pooled and invested. At its core, a pension fund is a time machine for money. It takes contributions today and stretches them across decades. The key is the discount rate. If you assume 7% growth, you only need $50 today to pay $100 in 10 years. In the early years, it works. Markets are stable, interest rates are high, pension funds earn reliable returns. The math holds. But benefits become more generous. Retirement ages decline, lifespans increase. The system expands because of incentives that point toward optimism. By the 1970s, cracks appear. Inflation rises, markets become volatile. To maintain assumptions, funds shift from bonds to stocks. The higher the assumed return, the lower the amount of money needed today. It's like planning to sprint an entire marathon. Through the 80s and 90s, strong markets reinforce these assumptions. But beneath the surface, the shift toward equities introduces dangerous volatility. The 401k rises. Private companies shift the risk to employees. But public sector plans remain, and these will dominate the coming crisis. Pension funds become active participants in complex markets, moving into hedge funds and private equity in pursuit of higher returns. Imagine the mechanics, contributions, investments, and liabilities. The health is measured by the funding ratio. 100% means fully funded. But liabilities depend on the discount rate. A fund can appear healthy simply by assuming strong future performance. It's accounting, not magic. Then comes 2008, a synchronized collapse. Portfolios assumed to be diversified move in the same direction, down. In the aftermath, trillions in unfunded liabilities emerge. The system designed for certainty is revealed to be built on uncertainty. Interest rates fall to historic lows. Bond yields vanish. To reach target returns, funds must take on even more risk. Demographic pressures intensify. Fewer workers contribute while more retirees draw benefits. It is a slow-moving structural shift. The ticking time bomb is not a specific asset. It is the gap between promise and reality, and it is already underway. What happens when a system cannot collapse but also cannot recover? By the late 2010s, America's pension system enters a phase that doesn't resemble crisis in the traditional sense. There are no flashing screens on trading floors, no emergency bailouts announced overnight. Instead, the stress expresses itself in quieter, more persistent ways. A school district delays infrastructure upgrades. A city defers hiring. A state budget absorbs an ever-growing pension contribution that crowds out everything else. The failure, when it comes, is not explosive. It is absorptive. To understand this phase, you have to follow the catalyst, not as a single event, but as a chain reaction already in motion. After the 2008 financial crisis, central banks around the world push interest rates to near zero. In the United States, the Federal Reserve maintains historically low rates for more than a decade. This decision stabilizes the broader economy, but it has a side effect that is rarely discussed outside financial circles. It breaks the arithmetic of pensions. Remember the core equation. Today's contributions plus investment returns must equal tomorrow's obligations. For decades, safe assets, government bonds, corporate debt did the work. When interest rates were 6% or 7%, these instruments quietly did most of the work. At near zero rates, they do almost nothing. This forces pension funds into a corner. To maintain assumed returns, they must shift further into riskier assets, private equity, venture capital, hedge funds, infrastructure projects. This is not speculative behavior, it is structural necessity. But with that shift comes a transformation in how risk is distributed and, more importantly, how it is measured. Public markets offer daily pricing. You can see losses immediately. Private markets do not. Their valuations are periodic and often smoothed over time. This creates a subtle but powerful distortion. Losses don't disappear. They become delayed. The system, in effect, becomes less transparent precisely as it becomes more fragile. This is the modern landscape of pension finance. And it sets the stage for the next layer of risk. Because once you obscure volatility, you don't eliminate it, you concentrate it. Now, walk through the mechanism again. A pension fund receives contributions and allocates capital across a diversified portfolio. If returns meet expectations, the system holds. If they fall short, the gap widens. In earlier decades, underperformance could be offset by higher contributions. Today, demographic and fiscal constraints limit those options. Raising taxes is politically constrained. Cutting benefits is legally restricted. So when returns disappoint, there are fewer levers to pull. This is where the catalytic pressure emerges, not as a market crash, but as a sustained mismatch between expectations and reality. Consider what happens when a pension fund consistently earns 5% in a world where it assumes 7%. That 2% gap compounds. Over multiple decades, it becomes structural. And because liabilities are long-term, the impact is delayed until it isn't. Cities like Detroit and states like Illinois become case studies, not because they are unique, but because they are early. Budgets are increasingly dominated by pension obligations. Credit ratings decline, investment in public services shrinks. The pension system, designed to provide security, begins to compete with the very institutions it was meant to support. But even at this stage, the system does not collapse. It adapts. States issue pension obligation bonds, borrowing money to invest in the market, hoping to earn a spread. It introduces leverage into a fragile system. These are tactical responses. They address symptoms, not structure. The structure is defined by long-term promises made in a high-growth era and a demographic shift that increases payouts. Look at the broader financial landscape. Private equity has grown into a multi-trillion-dollar industry, with pension funds as its largest investors. Pension funds are not just participants in modern markets. They are architects. Their need for return shapes the supply of financial products. This creates another feedback loop. The very act of seeking higher returns makes those returns harder to achieve. They are, in many ways, locked into the system they helped build. After years of low interest rates, inflation reemerges. Central banks begin to raise rates. Public markets experience renewed volatility. Complexity in systems like this is a source of risk. It makes outcomes harder to predict, harder to model, and harder to manage. First, identify the promise. What is being guaranteed? Who bears the risk if outcomes diverge? Second, examine the assumptions. Are those assumptions aligned with current reality? Third, analyze the funding mechanism. Where does the money come from? How stable are those sources? Fourth, assess the feedback loops. Fifth, evaluate transparency. And finally, consider incentives. Apply this framework to pension funds, and the picture becomes clear. The promises are long-term. The assumptions are optimistic. The funding relies on investment returns. The feedback loops are slow. Transparency is reduced by complexity. This is not a system designed to fail. It is a system designed to persist, even as it accumulates imbalance. Where did the money go? The answer is both simple and unsettling. It was never a static pool of wealth. It was a projection of future value based on a set of assumptions. When those assumptions prove too optimistic, the missing money is revealed not as lost, but as unrealized. The trillions were not stolen. They were expected. And that expectation was built into the system itself. So the conference room in the Midwest, filled with workers waiting for answers, is the visible edge of a much larger structure. The official at the front of the room is not announcing a sudden loss. He is revealing a long-delayed reality. The security promised by the system depends on variables it cannot fully control. Understanding this isn't about predicting distress. It's about recognizing the architecture of modern finance. The dynamics that define pension funds exist in insurance markets, sovereign debt, and corporate balance sheets. The next time you hear about a new financial product promising stable returns, ask what assumptions make it appear to work. The lost trillions were the difference between what was promised and what reality could deliver. And that difference is where risk lives.